Okay, it is Monday, January 19th, 2026. The markets have just closed, and I'm looking at these numbers and they just don't make any sense.
They look broken, right? A massive divergence.
Totally. You've got South Korea's KOSPI just smashing records. It's closing in on 5,000 points. And then you glance over at Hong Kong, and it feels like it's falling off a cliff.
It is. And our mission for this deep dive is to break down exactly why these two markets went in completely opposite directions today.
And not just why, but what the data predicts for the rest of the month and how you can actually navigate this.
Exactly. We've got a specific quant strategy for this exact situation.
All right, let's start with the rocket ship then. Korea. KOSPI up 1.32%, KOSDAQ up 1.44%. But the individual names, Hyundai Motor surged over 16%. Doosan Robotics is up almost 20%. What is going on?
This is the robotics revolution finally hitting the balance sheet.
So is that big CES announcement actually paying off now?
That's the one. Remember Hyundai's Atlas humanoid robot? Well, it's not a concept anymore. It's a production plan. It's hitting the factory floor.
Wow.
It's straight out of Günter Düeck's theory. You know, he argued that markets would eventually stop valuing human labor and start valuing the physical AI systems that do the work. We're seeing that happen in real time.
It feels like a fundamental repricing, but I also heard there was a policy change, something about a Commercial Act revision.
Oh, that's a huge factor. The third Commercial Act revision, it basically forces companies to burn their treasury shares instead of just sitting on them.
Which makes every other share more valuable.
Instantly boosts EPS, yes. It's what Simon Johnson called inclusive institutions. You shift the rules to favor the actual shareholders, not just insiders, and the entire market gets a re-rating.
Okay, so Korea is flying on robots and reform. Now the flip side, China and Hong Kong. The Hang Seng dropped over 1%. Why all the gloom?
It's two things, really. Internal brakes and external threats.
Okay, what are the breaks?
Internally, China just hiked the margin requirements. They went from 80% to 100%. That kills speculative trading cold because you can't borrow as much.
And the external threat, let me guess, the U.S.
The U.S. Commerce Secretary, Howard Lutnick, is now threatening 100% tariffs on memory chips.
100%. That would be a bloodbath for Chinese tech.
For most of it, yes. But here's the weird part. There was one big outlier.
Ooh.
Baidu. It actually went up 1.24% today.
How? In this environment?
They just launched their Apollo Go robotaxi service in Abu Dhabi. It's a classic case of decoupling. If you have real-world tech innovation that works outside of China, investors will still find you.
So that's the story of today. What about tomorrow? What are the models saying for the rest of January?
For Korea, the forecast is still incredibly bullish. Our models are pointing to the KOSPI reaching 5,150.
Wow, another 5% jump by the end of the month.
At least, it's that dual engine of institutional reform and the robotics hype carrying the momentum forward.
And what about Hong Kong? I'm almost afraid to ask.
The outlook is rough. We ran a Monte Carlo simulation, which basically plays out thousands of possible futures, and the most likely outcome is a further slide for the Hang Seng, down to around 25,200.
So the pain isn't over.
That cycle of regulation and tariff risk, it hasn't fully played out yet.
Is there one key metric we should be watching, one number that tells the story?
Absolutely. Keep your eyes on the U.S. 10-year Treasury yield. As long as it stays below 4.0%, our models project those Korean robot stocks will maintain their momentum. If it spikes, the cost of capital goes up, and this whole rally could stall.
Okay, so we have one market going up, one going down. How do you actually trade a divergence this stark without getting burned?
You use what we call an institutional tech divergence strategy. It's essentially a pair trade. You're betting on the winners to keep winning, but you're also hedging your bets against the losers.
Walk me through that setup.
It's pretty straightforward. On the long side, you allocate about, say, 50% of your portfolio to those physical AI leaders we talked about, your Hyundais, your Kias.
The core growth story.
Right. Then maybe another 30% on a satellite position, like Baidu or Doosan Robotics. But the key is the hedge.
Yeah.
20% of your portfolio goes into a short position.
So you're getting against something.
Exactly. You bet against the HS Tech Index or maybe specific chip makers that are vulnerable to those Lutnick tariffs.
So if the tariffs hit, your short position makes money and helps cover any other losses. It's like an insurance policy.
Precisely.
And what about timing? When you get in, and maybe more importantly, when do you get out?
For an entry point, you can watch the RSI, the Relative Strength Index. When it hits that 40 to 50 range, that's often a stable place to get in. As for getting out, we use a GRCH volatility model.
A GRCH model.
Yeah. It sounds complex, but the idea is simple. If the price swings get too wild, too unpredictable, the model basically screams, get out now, so you can preserve your capital.
That makes a lot of sense. Minimize risk, capture the spread. So to sum it all up, today was a tale of two markets. Korea sprinting ahead on robots and reform.
And China being held back by regulation and tariffs. And it all raises a really important question for anyone listening.
What's up?
In a world where physical AI is so clearly starting to replace labor, you have to ask yourself, are you investing in the technology that's building the future? Or are you still stuck holding the human economy?
A question to think about. Stay curious, check the sources if you want to see the math behind these models, and we'll catch you in the next deep dive.